This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think.
Hey, Steve Saretsky here. Welcome back to the show. We got an update from the Bank of Canada. We got some large movement in the mortgage market, and we've got some updates from the federal banking regulator, OSFI, how that pertains to real estate investors. So whether you're an investor today or you're planning to be in the future, I think these announcements are going to make an impact to your life. So we'll get into that in just a little bit. But I want to frame up this week's video with, if you've been following this channel for the past, let's say 6 months, you remember that coming into this calendar year, there's a lot of forecasts predicting when the Bank of Canada is going to cut rates, what's going to happen to real estate prices. There's one port that I highlighted in particular, and I said, well, that doesn't make a lot of sense. Basically, they were predicting, not only a rebound and an upshot in real estate prices, but also for the Bank of Canada to then cut rates by this summer. Of course, they haven't cut rates this summer. They've actually raised rates this summer, and we'll probably get another rate hike coming up here in July. And the reason being is that the economy's kind of muddling along. We haven't really fallen into necessarily a recession yet. But housing, essentially, as housing goes up, it basically gives the Bank of Canada more of an excuse not to cut rates. And if it starts really accelerating, you're like, well, geez, clearly consumers or households aren't getting the message here. We need to actually raise rates. And that's exactly what they've done this year. So, the Bank of Canada came out just a couple days ago, and they noted in their recent meeting of why. Why did you guys raise rates in June? And one of the reasons, there was a multitude, but one of the reasons they note saying housing resale prices, which feed into the CPI with a 1 month lag, had increased for 3 consecutive months. And so again, anyone that's following this channel knows that it's actually not been 3 months, it's been 6 consecutive months. The housing market really ultimately, and as I said, listen, there's a lot of indicators here showing us, people like to ridicule the fact that, I suggested there may or may not be a bottoming of real estate prices back at the beginning or end of last year and into the beginning of this year. And in fact, if you look at it, I operate in Vancouver here, detached house prices, for most all these young families that are entering the market, since January, you're paying about an extra $200,000 on your price. So you're paying an extra $200,000. You're actually about back to peak pricing of last year when mortgage rates were 2%. If you're looking for a condo in Vancouver, prices are actually higher today than they were this time last year. So by all accounts, yeah. Now, a lot of that is going to predicate, again, housing essentially had this sort of limited upside because of the Bank of Canada's conundrum with inflation and interest rates. And so as house prices have accelerated, because mortgage rates stabilized, it came back down to the 4s. As they've pushed higher and as house prices have pushed higher, it's prompted the Bank of Canada to come back in and re-raise rates again. So I think it's going to now test that thesis. I think that there's going to be some pressure on housing and on potentially on house prices, depending on how long rates remain at these levels. Now, again, as it stands right now, what I can tell you is happening feet on the ground is there has been no change in house prices, okay? It's been a couple of weeks since the Bank of Canada raised rates. Mortgage rates are back on the move. You've got your 5-year bond yield retesting that 3.8 level, which is the previous high for this cycle, which was back in, I believe, October of 2022. So you got your fixed rates going back up, your variable rates going back up. That's going to test the market. Now we're entering into a seasonally slower time of the year. The market always accelerates into the spring and seasonally was slow in the summer before re-accelerating back again in the fall. And so I actually think this is actually it's going to be a quiet summer. I think that the sentiment is starting to shift. We're starting to see multiple offer nights, bidding war nights. Not all, but some of them not failing, but only getting one offer, sometimes no offers, or instead of 8 offers, you're getting 3 offers now. So it's still a tight market. There's still, 15 to 20 year lows, depending on the market and the segment. You're still looking at 15 to 20 year lows in inventory. Now, what's going to be interesting to see is you're going to need listings to sort of continue to maintain, maybe accelerate a little bit as sales volumes fall off. That's going to allow inventory to build and put pressure on the market. Now, again, nobody should really be surprised if housing comes under pressure over the next 3 to 6 months. Now, again, as I said, you need inventory to come up before you actually see meaningful pressure on prices, because if sellers have no competition, they just sit there and they don't reduce their prices. If right now you have this, basically what's playing out is you've got mortgage rates, not all, but a lot of them, your 1 year, your 2 year mortgage rate, your variable rate, all with a 6 in front of it. So you got to get stress tested basically, let's say 8%. Well, as I mentioned to you in the beginning of the show here, house prices in a lot of these markets are back to previous highs when mortgage rates were at 2%. So you're telling me that you've got these prices at these levels with a stress test at 8%, clearly something is going to have to go in either direction. And that could be a multitude of factors. It could be over time house prices, again, ease because there's this lack of affordability. You could also get several CPI reports in the next 6 to 8 weeks that show, hey, inflation has changed. We're going to get a CPI report coming out, I believe this coming Thursday, GDP on, I think, Friday. So let's see how those numbers come in. If they come in higher than expected, bond yields push higher once again, that's just going to put more downwards pressure in over time on the housing market. So I think what's important here is to be able to sort of pivot with the data, right? Like as we've talked about, as of right now, today, the best time to buy a house over the last 12 months was in September, October of 2022. When sentiment was at its lowest, sellers were willing to give out big negotiations, big discounts. You saw this bottoming in January and prices accelerated higher. A lot of that was on the thesis that, okay, if bond yields continue to sort of ease off as headline inflation comes down, you get mortgage rates back into the low 4s. I think there's a pretty good argument to say, yeah, house prices are going to continue on this sort of relative trajectory. And now what you're seeing again is bond yields reaccelerating higher. So if that information changes, once you change, it's like these people that look at, during the pandemic when the people were just fighting it, and mortgage rates dropped. You could have got a 5-year fixed mortgage at about 1.3%. And people were just not willing to accept that we are in this bull market. And that's one of the largest drivers for it. Mortgage credit borrowing, I think, reached 15-year highs, mortgage rates at 1.3%. Of course, prices are going to accelerate. So you have to be willing to sort of change and try to let go of those biases as the incoming data changes. And so I'm going to be watching the incoming data over the next 2, 3, 4 months. As I can tell you right now, I think buyers are going to get some opportunities in the summer. I think the days of these crazy bidding wars in the spring market, clearly unsustainable when you're getting stress tested at 8% and Bank of Canada is continuing to raise rates. Of course, the market and sentiment is going to change. What's going to be important, again, is these CPI and GDP reports coming out over the next 3-4 months. But we're still in an environment with very low inventory. But again, it's going to take a bit of time for conditions to really change in a meaningful way. But there's going to be a slight easing in the summer. I think it's going to be a quiet summer in general for particularly people such as myself in the real estate industry. Now, another important note to take note of is OSFI coming out with some rule changes. So the banking regulator, I was tipped off about this, 3-4 months ago by one of the big banks, basically looking at tightening the number of mortgages they're willing to lend to investors. And so I believe previously you could have gone to a bank and you could have got, you were capped out basically in any of the big 5 banks or federally regulated banks at 10 residential mortgages. So you could go and say, hey, listen, I want to own 10 houses, and you could do that. You could own one primary residence plus 10 investment properties. Under the new guidelines, looks like it's seemingly going to be confirmed in a matter of the next couple months. We had reaffirmation from my good friend Ron Butler this week, showing that OSFI is going to come out with changes that's going to take that down to 5 properties. So moving forward now, if you're an investor already with, let's say, 7 units under your personal name, that is you might not want to sell, because you might not be able to add to the portfolio moving forward unless you go to, let's say, a credit union who does not fall under federal regulations. And so moving forward, if you're looking to sort of accumulate doors, you're going to be capped out at 5. So your primary residence plus 5 additional properties on the residential side. Now, the reality is anyone that's doing this at a more professional level is typically involved in commercial mortgages. They typically have a book of commercial investment properties that go through the commercial lending program. You're probably doing it through a business corporation, and you're running it like a real business. Or again, if you're buying a small apartment building, 8 doors, 10 doors, 12 doors, you have to go commercial. Residential gets capped out at 4 doors, right? So fourplex, for example, gets capped out on the residential side by 4 doors. As soon as you have 5 doors on a property, it automatically goes to the commercial underwriting mortgage program, and so that won't have these restrictions, right? So just keep that in mind as you hear these headlines coming out, and as the policy officially gets announced in the coming months. That's something to sort of take note of. But like I said, on a professional level, anyone doing this at a real level is most likely already doing it through the commercial program. But understandably, I know where OSFI is coming from. I get it. There's certainly be a lot of scrutiny around investors, accumulating properties and pricing out first-time home buyers and of that nature. And I think that's certainly been an element of it. But in this decade of zero interest rate environment, who has the most access to available credit, cheap credit? Well, it has been obviously investors that already have a large asset base. So an interesting change, but I think it shouldn't be surprising given where the political conversation has gone around housing over the last 3, 4, 5 years. Mortgage stress tests, empty homes tax, vacancy taxes, speculation taxes. Now we're hearing about flipping taxes coming out. So it's understandable to see where that ball is going. But that's kind of my overall summary. Going to watch and wait and see. Again, I think the Bank of Canada is probably going to move in July. Another rate hike just changes sentiment in housing. The household debt as a percentage of disposable income continues to push higher. The debt servicing ratio currently sitting at its highest levels, I believe, since 2008 at about 15%. We're going to see it probably touch 16% sometime next year. And so these interest rates, like I said, they're going to take time to filter through. We're going to see them filter through. And so I still think there are a lot of risks ahead. Buyers, I think, will get some easing here in the summer months, and we'll be data dependent, as we always try to be on this channel moving forward. As always, hope that helped. See you next week.